It's Wednesday the 22nd. Good morning. Oil goes up as the White House plays down Iran talks. Alphabet, Tesla and Texas Instruments all dropping numbers later. It's a big day for tech. And we should probably talk about Trump's plans to raise generic drug prices in America, Tom.
So that is the oil price reaction on the back of those comments from President Trump, to your point, suggesting that he is and the US plans to stick around in the region for some time. So up 1%, above $92 a barrel right now. The Japanese yen in focus. More comments from Katayama, the finance minister, suggesting and nodding to bold, quote, bold action, but up 163 for the Japanese currency, back to those 1986 levels in terms of the weakness for the currency. Nasdaq futures, interestingly, now pointing lower by 0.5% after a strong session for the Nasdaq 100 yesterday, and the Kospi over Korea has given up much of the gains of the session. So maybe the modest optimism we've seen over the last few days around the semiconductor space, and particularly memory, is starting to fade a little. Nasdaq 100 futures pointing low by 0.5%. The countdown to the opening trade starts right now.
Welcome to the programme, everybody. This is the opening trade. Then just gone 7 o'clock here in London. And let's talk about what we're seeing in energy markets. Yes, the tech story, the earnings story out of big tech will certainly be dominant later on in the trading day. But for the moment, let's think about the oil price. We're at $92 a barrel once again on the Brent price, up another 1%. And you said this is President Trump downplaying the prospect of talks. And as we see the tit-for-tat exchanges between the US and Iran, this continues to be the question. What does this mean for talks? Are we going to get these two sides around the table? Because for a lot of the guests we talked to, that still seems to be the base case. They think that this doesn't re-escalate in a major fashion and it remains contained. So the US is vowing retaliation against the Houthis. They say that Iran wants talks. Iran says it's the mediators who've been reaching out to them for talks. Meanwhile, oil has been going higher and higher and higher during the month of July. OK, we're not at highs, but we're up by 29% during the month of July.
Through 90 on Brent, we're through $4 a barrel when it comes to US gasoline. Are these key lines in the sand that President Trump is going to pay attention to? Will they limit his capacity to go further from here? I think the market is looking at that, hoping that that's going to be true. Whether or not it turns out to be true remains to be seen. The market's beginning to reorganise around the idea that this conflict is going to continue and that we are potentially, and this is the kind of talk in the background, that a ground conflict is potentially back on the table as well.
Because Anna reminding us that the consensus that we hear from many of our guests is that ultimately there will be a conclusion to this conflict, that they will be able to square this away. But do they have to escalate to de-escalate? And if so, how should investors think about positioning around that? $92 a barrel on Brent right now. European equities seem to be able to look through this, at least for now. Gains of around 0.5–0.6% yesterday. Futures pointing modestly higher today, despite the fact that the view is, and we know this, the facts is that Europe is more exposed to that energy price input, and we're seeing gas prices up again today.
And we add in another complexity, which is over the last couple of days, the threat from the Houthis to blockade Saudi energy. And we're watching for any signs that that is impacting behaviour in the Red Sea, because that Red Sea route had proven to be very useful to the Saudis and very useful to European consumers and global consumers of energy products as they were trying to find other routes out. And it does seem as if we are seeing some vessels turning around and changing course, heading back to Suez or going via Suez, for example, as a result, but not everybody. So we're watching to see if this is going to have a really an impact on the Red Sea.
The reserves are empty, though. That's the difference between this time around. You can't call on the SPRs around the world to kind of bail us out this time. Yeah. So therefore, are we more prone to big spikes in the price? And is that kind of volatility, again, something the market is going to have to get used to and manage?
And this is still summer, and we talked to Goldman Sachs earlier on this week about their concerns around storage of gas going into the European winter. That's certainly going to be something that we're watching. So
that's one key factor for investors this morning. The other, I think, is going to be what's happening in the earnings space, particularly when it comes to Alphabet. Interesting that the gains that we saw for the Kospi at the start of the session in Asia have faded. So we look ahead to Alphabet's earnings. I think a really important test of a number of different things. Number one, the CapEx story. This is a company that has promised and has forecast spending of $190 billion of CapEx just this year. That's double in 2025. That's the expectation for 2026, $190 billion and more, much more, that the CFO has said previously in 2027. So the CapEx story will be tested with Alphabet. The What's happening with the cloud business will be tested as well. Can they ship more products with AI infused to their customers? What's happening with the latest Gemini model? And is the search part of the business and the revenue strength that's come through from that, is that still holding up in the face of competition from OpenAI specifically and others chipping into the search space? So I think in all those key metrics, Alphabet is going to be really consequential.
Is it worth it? Is all this investment worth it? That's what it boils down to. And I think that's the question the market's going to ask again with greater focus tonight.
Yes, and that is it worth it question perhaps hinges on what is the right look for capex right now? Do you want really barnstorming capex that shows confidence, or do you want capex that moderates to show restraint? And I don't know if the answer to that question is the same for different businesses. You know, maybe it's a different answer to different questions. We'll talk to Matt Bloxham a little bit about that later. I'm also interested in IBM we talked about last week and that incredible stock drop of 25%. We're going to hear from them in more detail today. AI crowding out other things in the IT space. I think that's really interesting. Or just other things generally. AI crowding out is also an interesting theme. It's not just IBM with their mainframes and their software and their consulting that might be hurt. What else might be hurt by everybody's seemingly myopic focus on what AI can do?
Can we just talk about Hugging Face? A cool company name. Hugging Face.
Yes. French-American company.
Okay.
It's got a little emoji. The emoji is literally the hugging face.
Okay, nice.
Which I think they started as a bit of a joke, and then it got traction, so they kept it. So it's a community of open source. So it's where you can go and look at different models. There's lots of data. There's lots of research, but it is the go-to place if you want to learn about different models, the most up-to-date models. If you want to learn about the most recent data sets and research. But
OpenAI's latest models clearly wanted to know that.
Yes.
So these were models that were in a sandbox, contained from the internet. Some of their parameters were loosened so they can have a bit more flexibility. These are cutting-edge models. They found a way out of the sandbox, i.e. they found a way to the internet and then hacked Hugging Face. This is scary stuff. The sandbox is the really important part of this. Yes.
It was not meant to be. It was not connected to the internet. It found a connection to the internet to hack Hugging Face. And this is a similar behaviour that we've seen from Anthropic's most recent models as well. OpenAI, Sam Altman putting out a post on this. The consequences are there. And we know the Trump administration is now looking at a system that has to check these models before they go out. It has to accelerate that.
That, I think, is the interesting bit. So we talk about the kind of the numbers we're going to get later on and whether it's worth it. Is the biggest threat regulation? If we start to see more and more of this, is that where the threat to this AI story ultimately comes from? Is that governments just get really nervous?
The Markets Live event we did a few weeks ago, you were asking the audience, what brings down the AI trade? And one of the things that came out from the audience actually was that concern around regulation, not just in Europe for certain. This was around the US as well.
Let's talk about Trump's new plan to raise generic drug prices in America. So basically, here's the plan. You either move your production to America or we hit you with massive tariffs. 2 years out, 100. Further than that, you get 200%. So basically, you're going to get whacked with massive tariffs if you don't produce in the United States on generic drugs. America relies on generic drugs. Let's just kind of put this in context. A lot of Americans take these drugs. They are relatively cheap compared with the branded products. And a lot of that is because of the fact that they are manufactured in places like India. Companies like Sandoz and Teva obviously are a big part of this narrative. If you put tariffs on this stuff, prices are going to go up. If you manufacture in America, prices are going to go up. Either way, it looks to me as if we're in a situation where generic drug prices, which are part of the affordability story that Trump's taking into the midterms, are going to go higher if he enacts this plan.
He would argue, of course, this is about onshoring, and he would probably push back against the idea that you'd have to produce more expensively in America. I'm sure many economists would be on your side.
He probably would, but all of the people that we've spoken to and all of the stories I've read on Bloomberg this morning suggest that that is not the case. That it is likely that the reason why we're producing these drugs in India is because it's cheaper to do so. So therefore, if you produce in America, it is going to get more expensive. So this looks inflationary to me.
Generics accounting for 90% of prescriptions in the US. 90% of prescriptions are generics. It's going to take more than 2 years, the argument goes as well, from those in the industry. It's going to take more than 2 years, which is the time frame they've been given, to actually build out manufacturing capabilities for generics. Before we even get to the question of cost and what that does in terms of raising the cost of these drugs.
The scale of doing it is enormous.
So it takes 3 years. that's a problem as well.
Whilst we're talking about inflation, shall we divert our attention to the UK for a moment, because we've had UK inflation and, of course, everything cost of living very much in focus right now politically here in the UK. So CPI year on year coming in at 2.6%. That is the actual number. That is just below the estimate, which was 2.7%. So that looks slightly light. But then if you look at the core CPI year on year, that is above the estimate just slightly. Services often a big focus in the UK, and that is a little above the estimate as well, running at 3.6%. So that is perhaps what people are experiencing in an economy that is predominantly services.
Yes, many things to say on this.
Yeah,
We'll
return to them
to another time. What have we got coming up on today's show? We've got two earnings conversations. We're going to talk about inflation with our first guest, Greg Poux-Guillaume, AkzoNobel's CEO, out with numbers this morning, raising prices. The inelasticity, if I can say that fast, particularly of the industrial side, really interesting at the moment. Jose Garcia-Cantera, Santander's CFO, will be joining us at the Open. Will Hobbs is going to be joining us a little later on. Brooks McDonald, CIO, and Raffaello Cristieri, RBC Wealth Management's fixed income head for Europe, joining us a little later on in the programme, Tom.
OK, let's look ahead to what else we are watching throughout the day. ASEAN foreign ministers, that meeting continues in Manila, in the Philippines, of course. At 9 a.m. UK time, we will get CPI, inflation out of South Africa. Samsung is hosting its Galaxy Unpacked event in London, so revealing its latest smartphones. European earnings from Moncler in the luxury space and Deutsche Börse. And we will be watching, of course, for earnings and results coming through from Alphabet, IBM and Tesla aftermarket stateside.
Coming up on the programme, France moves to become the first major European country to ban social media for children. Lots of other countries have plans in this direction. Many in Europe. We'll get the details. Plus, we will look at the stocks to watch at the Open, including Santander, the Spanish lender confirming its guidance as it reports net income above expectations. Can it continue to add new customers at that rate? Up next, as Guy says, we'll be speaking to Greg Poux-Guillaume, the CEO of the Dutch paint maker AkzoNobel. Inflation, also M&A, very much in focus. Please get in touch with us. We do like to hear from you. IB plus BBTV Go. That's the function on the Bloomberg terminal that puts you in touch with us and the team. This is Bloomberg. Welcome back to the opening trade, everybody. So 7:15 here in London. Yesterday, we saw a continued recovery stateside in some of the chip names. That did pass through into Asia for some of the morning's session, some of the Asia session. We're towards the end of the Asia session, up by 0.1%, though, so not a hugely positive handover now. And Nasdaq futures actually pointing lower by 0.7%. So that's the overall vibe, I suppose, globally, Guy. Amidst that, though, European stocks, despite the higher oil price, find room to go higher.
OK, let's talk about some of that and let's talk about paint and pricing power. Two things that seem to go hand in hand at the moment. AkzoNobel out with numbers this morning, reaffirming its adjusted EBITDA forecast for the full year. This after reporting second quarter results. It also very firmly of the belief that the Axalta merger is on track and will close late 26 or early 27. Greg Poux-Guillaume is the CEO of AkzoNobel. He joins us now. Greg, it's always a pleasure to speak with you. Let's talk about the big picture. Clearly, there's an input story which is negative, but there's an output story, a pricing power that looks quite positive. Greg, you seem to have quite a lot of pricing power right now. How sustainable is that?
We think it's sustainable. I think the story of the second quarter is that the world is a resilient place. It's an unpredictable place, but it's a resilient place. We took prices up. We had to because our raw material basket was going up in the teens, and we increased prices enough to mitigate that, and that hasn't negatively impacted demand. Organic sales for us are up 2% in the quarter, so far so good.
Is there a difference between the two components of the business? One is kind of household, one is performance coatings. Let's call that sort of the industrial side of things. If I look at the margin story in household, you're a little below consensus. If I look at it in performance, you're kind of ahead of expectations. Do you have greater pricing power when it comes to the industrial side?
Yeah, I think the consensus for EBITDA is 392, and we're at 398. So we're tracking really well. And you're right to say that there's a difference between the two sides of the business. The coatings businesses, which are B2B businesses, industrial businesses, have a tendency to be GDP driven, and the deco businesses, which are consumer businesses, have a tendency to be driven by consumer confidence. And what you see is that our volumes are up in the coating businesses by about 2%, or volumes are down in the decorative businesses by about 4%. But it's really a mixed bag. It's more geographical than anything else. China and Europe are down a little bit, and Latin America and the rest of Asia are up significantly. And in Europe, it's not even homogeneous. Southern Europe actually did well in Q2, and Northern Europe was lagging.
Greg, good morning. Can you build on that a little bit? What do you think are the factors leading to that split in Europe? When does China turn around for you? When does Europe turn around for you?
Well, China is not showing signs of turning around in the decorative paints businesses. Our business in China is about €1.5 billion of revenue. About 2/3 of that is in coatings, and the coatings businesses, marine protective, powder, automotive, are doing well. Deco is depressed because the real estate market in China is depressed, and it's going to continue like that for a while. We were waiting for a sign of rebound for 2027. It's not clear that rebound is coming, but at least the market seems to have bottomed out. In Europe, Southern Europe once again was dynamic in the second quarter. In Northern Europe, part of the impact was the UK, and in the UK there was a little bit of destocking ongoing, and a reshuffling of the market after the home-based bankruptcy last year. So nothing to be overly concerned about, but consumer confidence is not very high right now for obvious reasons.
And you talked about, just going back to your first answer on the input costs in the early low teens, I think is what you said, Greg. Is that a logistics? Yeah. How much of that is down to logistics? How much of that is down to material costs? And is that kind of level of input cost what you expect to see over the quarters ahead, or does it pick up as we see Brent and WTI up above $92 a barrel on Brent and the continued disruption we're seeing in the Strait of Hormuz?
Yeah, most of it is actually raw materials. Logistics does matter, does impact, but the lion's share of the impact is raw materials. And it has to do with the disruption in the Strait of Hormuz and the fact that the chemical value chains have been thrown for a loop by the fact that some of the inputs are having trouble transiting. So when we calibrated our price increases, we were shooting for a raw material basket impact of in the mid-teens. It was recently looking like it was going to be more in the low teens. The flare up in the Middle East again is raises a question mark, but we're confident that the price increases that we've put through already are going to cover whatever impact we're going to have this year. In China, raw material prices had started going down, so there were signs of a beginning of a rationalization, but who knows how the situation is going to evolve. What's important, though, is that the price increases have gone through and the volumes have not been impacted.
Greg, can I ask about M&A? You've rejected an offer from Nippon Paint for your decorative paints unit. You're preferring this described as a merger of equals with Axalta. You've confirmed today some timing around the Axalta deal. Are there any circumstances under which you consider another offer, maybe a revised offer from Nippon? Because there's not a lot of detail about what Nippon is offering.
Well, Nippon made an offer for our decorative paints businesses, which are about 40% of the company. So as per our merger agreements, anything that's for less than 50% of Akzo, we can't consider currently. But even if we could, I mean, what do we have in common with Nippon? We have in common the fact that they are essentially saying that our deco businesses are really good businesses. We agree with them. They're saying that the market doesn't recognize the full value of these businesses. We agree with them. And then beyond that, they made an offer which doesn't represent the value of that business and is not even close. So not engaging with them is not a dilemma right now, but we appreciate the interest.
Appreciate the interest, but you stick with Axalta, and I think as a result of Axalta, you end up moving your listing to New York. Is that part of the motivation?
Well, it's not part of the motivation. The listing to the U.S. is that the investor base in paints and coatings is overwhelmingly a U.S. investor base. Akzo today has more than 60% of its shares in U.S. hands, so it just makes sense.
Greg, just to wrap things up, you look ahead. You're a CEO of a European company dealing with a pretty big input cost story that you're trying to manage right now. Is this something that you think that we're just going to have to get used to, that we are seeing an inflation trend that is going to be here for a while, that we are seeing deglobalization, that we are going to see increasing conflicts? As a CEO that has to manage input costs, is this something that you're kind of geeing your team up to get ready to kind of manage on a long-term basis? Or do you see this as being something that you can raise a few prices here and there and you can look through?
No, it's a long-term issue, very much as you described. It's Europe's going to have high gas prices for the foreseeable future. Gas is the input of a lot of chemical processes. Europe's going to have high energy prices for the foreseeable future, and a lot of our suppliers are energy intensive. So you have a supply environment in Europe which is going to be challenged for years to come, and this is also why the European Commission has to have an industrial policy to tackle that and keep Europe competitive. Now, as Akzo, we're a global business. We have global supply, and therefore we're able to juggle and mitigate. But for Europe, it's very much a situation of concern.
Okay, Greg Poux-Guillaume, AkzoNobel CEO. Thank you very much indeed. There we go. It's a longer-term story, and Europe has to adjust to those higher prices. Here's what else you need to know this morning then, Guy.
OK, President Volodymyr Zelensky has dismissed the commander-in-chief of the Ukraine's armed forces. This after nationwide protests calling for the top soldier to go. The demonstrations were triggered after Zelensky removed the country's defence minister, who had been locked in a power struggle with the military chief. Zelensky has promised changes of the, quote, configuration of military staff without providing further details. Watch this space. Chinese car brands snapped up more than a third of new plug-in hybrid sales in Europe last month. That's according to data from analysts at Dataforce. It says manufacturers, including BYD and Chery, are pushing sales of plug-in hybrids, this ahead of any potential additional EU tariffs. Currently, only fully electric vehicles made in China face those steep tariffs. And as we were mentioning earlier, France has passed legislation to restrict the use of social media for children under the age of 15. Children will not be able to create new accounts from September before a full ban comes into force in January for existing profiles. France would be the first major European country to bring in such a ban in a move that may strain relations further with the United States, tech companies, and of course, President Trump.
Where Australia went first, perhaps, many European countries look set to follow. So France, but there's a list of other countries who are interested. Germany, Greece, Portugal, Denmark, Poland, Austria, Ireland, the UK, of course, also has plans. So it looks as if this is a turning of the tide, perhaps, or at least an attempt to.
There's more to come. There are more countries who are going to look at these models of restrictions and roll them out. Obviously, there's impacts there for Meta and TikTok and others within that space, but US and China.
The biggest challenge here is children. The biggest challenge here is not anything else. The biggest challenge here is children. Children
are
really good at getting around whatever restrictions you are ultimately going to throw up.
OK, breaking out the sandbox. Coming up, Santander second quarter net income beats estimates. We're going to speak to the company CFO, Jose Garcia-Cantera, next. This is Bloomberg.
30 minutes ago until we start cash equity trading here in Europe this Wednesday morning. Let's take a quick look at European futures. That's what they look like right now. They're beginning to soften up a little bit. So Euro Stoxx 50 futures are now negative. Elsewhere, kind of up to 0.3%. The story I'm watching this morning is Nasdaq mini futures rolling over. So when I got in this morning, they were down kind of 4.5%. They're now down by 0.8%. So the story's getting a little bit more negative, certainly over the last half hour when it comes to that picture ahead of tech earnings a little bit later on today, Tom.
Oil is part of the story, heading towards $93 a barrel on Brent, and you're seeing that reflected arguably in what's happening in the fixed income markets, with yields up between 1 to 2 basis points across most of the key sovereign bond picture that you see there. The German 10-year is currently yielding 3.17, yields up just 1 basis point. Similar picture over in France, 3.98, and Italy's BTPs as well. Brent currently up $92.88, up 2% so far in the session.
Let's talk about some of the earnings stories we're getting out of European corporates, and we'll start with the banking sector. Banco Santander's second quarter net income has beaten analyst estimates as it continues to add customers. Spain's biggest lender says it signed on 12 million new clients in the last 12 months. We're joined now by the Santander CFO, Jose Garcia-Cantera. Very good to see you once again on the programme, Jose. Thank you very much for joining us. Let's start with that growth in customers then. You've beaten estimates, it seems, at the net level, and some suggesting it's because you keep adding these customers. Can you keep doing it at this rate? Is some of that TSB? What is your expectation for how fast you grow?
Good morning, and it's great to be here again. We integrated TSB in the second quarter. TSB added 4 million customers. If we exclude this one-off, we added 8 million customers in the last 12 months. This is the highest number in several years in terms of new customers. This is coming from the transformation that we are undertaking at the bank. This transformation, many analysts and investors look at transformation only from the cost side, but transformation means offering better services, better products to our customers. And our customers are reacting to this. So we are actually accelerating the acquisition of new customers in the last 12 months relative to, as I said, the previous years.
OK, and does that leave room to perhaps take guidance a little higher, Jose, in the future? You've got some targets, net profits, more than 20 billion euros by 2028, achieving 20% return on tangible equity. What flexibility is there around those targets, do you think?
These are 2028 targets. I think 2026 is the first year of this 3-year plan. And clearly, we are on track or even, on track to meet or even do better in some of the KPIs we gave for the first year of this 3-year plan. So we are starting on very, very strong footing, and we are very confident that we can deliver on the numbers we gave for the next 3 years.
You and the team have made it clear, Jose, good morning, that the UK and the US are key markets for Santander. You've made the acquisition, of course, of Webster in the US, TSB, as you mentioned, here in the UK. Are you still at the point where you're integrating those businesses, or are you looking for further acquisitions? Where are you in that story?
No, we just incorporated TSB in the second quarter. We are going to, we expect to incorporate Webster in the second half of this year. And we need to integrate these two companies, these two banks into the group for the next couple of years. So obviously we need to, we are going to focus all our resources on integrating these two companies in the next couple of years. So no significant M&A on the table at the moment, no.
OK, does that allow you to think about maybe returning more cash to shareholders above and beyond the announced amounts?
At Investor Day, when we outlined our next 3-year plan, we made a few changes to our distribution policy. We increased the cash from 2027 onwards, from 25% of profits to 35% of profits. And we also said that if capital stays above, or when capital goes above 13%, which is the upper end of our operating range, which is 12 to 13%, so the excess capital above 13% will be distributed to shareholders.
Good morning, it's Guy. For every euro that you invest in AI, what is your rate of return?
Well, it's very early days. I don't think I can give you a number. What I can tell you is that we are putting AI in almost everything we do. The new apps incorporate AI. The new version of our core banking system, Gravity 2.0, already incorporates AI capabilities. So the new apps that connect with the core banking system can benefit from that. So clearly we are redeploying AI in everything we do. Given a number at this point is impossible.
Why is it impossible? How many other assets that you invest in could you not give me a rate of return on? If you invested in a new building or a new something else, you presumably be able to give me a rate of return that you expect from that that asset, that investment. Why is AI different? Companies are really struggling with this at the moment. They're using it, they're deploying it, but they still can't give numbers in terms of what it's actually going to deliver back to the business.
Well, because when I buy a building, I spend a fixed amount of money on a fixed asset, and I can measure the return on that asset. So it's easy to see the return on the capital invested. AI, as I said, is being, let's say, redeployed all across the group. My team, when they do capital analysis or when we do the ALCO portfolio analysis, we use AI. AI is expense at that time. And that allows us to do things that we were not able to do before. Better things, more quickly, etc. Connecting the two is not that easy. It's not as easy as doing it for a fixed asset like a bank or a building.
Yeah, interesting. We'll no doubt deep dive into some of these P&Ls with various CEOs and CFOs, Jose, and see what we can come up with on that subject. Can I ask you about the trajectory for the Spanish economy? Doing very well by European standards, boosted by migration, by European funds, by no doubt other policies as well. I don't know if the World Cup win makes a difference. What is your expectation for Spain?
No, it was great to see Spain winning the championship. Actually, we're very proud of what the team achieved, and we're all very happy. How is this going to translate into economic impact? I think it's not going to be that great. Having said that, we expect Spain to do a lot better than the average European economy or than the major European economies in the next few years, like it has been the case in the last few years or in 2026. So Spain is doing well, and we expect it to continue to do well, and relative to others, to do better.
So if we fold that then into the broader picture for the macroeconomic story across the Eurozone, Jose, what are your expectations around the ECB and further rate increases if and when they come?
Well, I think Lagarde was very clear. No, this all depends on the outcome or the developments in the Middle East and how this translates into inflationary pressures or not. So far, this translation is happening, but it's very moderate. And I think we need to wait and see how this develops. Having said that, we expect one more rate increase in September. And from then, I think the ECB will react to data, which is what they have reiterated, and I think is the right way to do things at the moment.
One final quick question from me. Do you expect bank taxes in the UK to go any higher? We've got a new government here. It's on the agenda. Jamie Dimon's out talking about the fact that it would be a really bad idea. What do you think?
We have been the largest investor in the UK, financial investor in the UK for over 20 years. We just acquired TSB. We have been one of the largest investors in the UK in absolute terms in the last years. So we believe the UK is a great place to be. It's a great place to do business. The government, it's been formed as we speak, so it's very early days. This is obviously all speculation, but we have said this many, many times. Obviously, we believe that individuals and companies must pay a fair amount of tax. And this must, when targeting a particular sector, be it the banking sector, the utilities, any sector with special taxes, they need to assess very carefully the consequences of that, because there might be unintended consequences. The banking system is particularly sensitive because it provides the leverage to the economy to grow. So we believe, again, that a tax regime must be fair to all companies.
We'll leave it on that point. Fair enough. Jose Garcia-Cantera, the CFO of Santander, always a pleasure. Thank you very much indeed for your time. So the Farnborough Air Show is still ongoing. Defence leaders certainly weighing in over the last couple of days to me on how the UK and Europe can boost sovereign capabilities.
Is it about money or is it about getting the capability at speed?
Yeah.
And it's a bit of both. And so we all recognize that to be relevant in this day, we need to move faster. The solution to that is we need to expand our capacity. So the intersection that we're looking forward to is expanding that capacity here locally in the UK or across Europe, in order to get after both speed as well as integrated, interoperable, allied capability, which will help all our nations feel safer.
That was Orlando Sanchez, the new president of aeronautics over at Lockheed Martin. He's got a cool resume. Used to fly an F-22, used to run the Skunk Works. These are cool jobs that he has done in the past. Anyway, speaking to me yesterday at the Farnborough Air Show. Up next, we're going to discuss the ongoing war in Iran. President Trump playing down the prospects of a deal. We'll talk about that next. This is Bloomberg.
We are doing very well. We are degrading them at levels that nobody thought was possible. They're being degraded really so seriously. They did slip something through in Jordan, and if we had other operators, would not happened, unfortunately. But because we have the best equipment in the world.
US President Donald Trump speaking from the Oval Office yesterday, talking about the situation in Iran. Brent crude, Tom, trading higher and higher. We're above, what, 90 now?
92.85, closing in on $93 a barrel, up more than 2% so far in the session. Those comments, of course, from President Trump coming as escalating hostilities extend across the Middle East, threatening global energy supplies, of course. Once again, this comes as attention draws to the Red Sea, where Houthi threats on maritime traffic impact another key shipping route for oil. Let's bring in Bloomberg's Paul Wallace, managing editor for Middle East and Africa, EcoGov, for some context and analysis. Paul, what is the current state of the energy market right now? What is the outlook? How's the outlook been adjusted by those in the space, in the sector, on the back of what Trump has been saying, suggesting that maybe he's not in a big rush to end this?
Yeah, and I think if anything, energy markets are just more bullish this morning. As you've just shown, Brent's now above $92 a barrel. It's at a 6-week high on a closing basis. Refined fuel prices continue to go up. If you look at European wholesale diesel prices, for example, they're soaring. In the US, gasoline pump prices, petrol prices that is, are back above $4 a gallon. So I think the energy market and energy traders are very much looking at this with a lot of wariness. Iran is not backing down. For all that Trump is saying that that the Islamic Republic is being seriously degraded, there's little evidence of that. Iran continues to retaliate against US attacks by hitting countries like Kuwait, like Bahrain, and as Trump mentioned, Jordan, where the US has seen, I think the tally is now 3 US service members killed in the past week or so, not to mention another soldier that was killed in northern Iraq in the same time frame. So things seem to be escalating. The focus is very much the Strait of Hormuz. The US is saying its attacks on Iran are designed to make Tehran reopen the strait and stop attacking ships going through this vital waterway. But as I said, there's just little sign that Iran is going to back down. We know, and we've seen this from the start of this war in late February, that Iran has a very high pain threshold. It sees this conflict as pretty much existential, at least for the theocratic Islamic Republic, and it's signaling that it's willing to take much more in the way of US attacks, and it is able to continue striking in the rest of the region.
OK, we're going to leave it there. Paul, thank you very much indeed for the time. Paul Wallace joining us out of Dubai on the energy markets.
Let's turn to the broader market conversation in 3 minutes on the opening trade. Adam Linton joins us from the Bloomberg Markets Live blog. Adam, good morning. We are looking ahead to tech earnings. We're still dealing with a very volatile AI story, and I don't know if tech earnings are going to calm down our thinking on that front. What's ahead for you this trading day?
Yes, I think looking forward, I think the key thing is these Alphabet earnings after hours. Really kind of kicks off things for hyperscalers before things get a little bit busier next week. I think, my colleague Anthony Stevens flagged that one-day vol on hyperscaler earnings day is higher than it is on FOMC day. So this is a big deal for us to look out for. In terms of Google's earnings specifically, a lot of focus is going to be on the CapEx space. So we saw last month, they did that $80 billion equity raise, sent their shares lower. So obviously there's a high sensitivity to what we're hearing on CapEx. And, a lot of focus is also, on, how much they kind of thread the needle. We don't want to see too high a CapEx, as, it could be fears of overbuilding, and then an undershoot could potentially be, more of a detrimental story to the broader AI infrastructure story. At the same time, also need to see some evidence of monetization. Some signals on that haven't been relatively positive. We've seen delays to Gemini. We've seen top talent leaving. So those are the key things to watch. But more broadly, I think the trade is, if we do see a well-received report, what happens with tech as a whole? Heading into the second half, the chart I just kept seeing time and time again was the ratio of, semiconductors to hyperscalers. Do we see a bit of further rotation into that? If we see a hyperscaler positive beat, then also what happens with, value into growth?
UK inflation at a 15-month low right now on the back of the data that came out at 7 a.m. You've got that story. You've got the story of a prime minister who's clearly determined to drive prices lower, and yet the markets are pricing in 40 basis points of hikes by the BOE. Does that need to be rethought?
Yeah, so I think in terms of, the inflation report we saw this morning, that was a third consecutive downside surprise. It's about 50 basis points below where the Bank of England ultimately expected it to be. But obviously since then, we've seen the MOU between the US and Iran break down. As I walked on the set, energy prices are just continuing to ratchet higher. But ultimately, I think, today's data gives you a lower starting point for, when those energy prices keep going higher and higher. Bloomberg Economics thinks we'll probably get to about 3% on inflation, which for the Bank of England is relatively good news, like 3.5 to 4%. That's kind of their danger zone for where they see inflation. So to me, it does look a little bit stretched, particularly given the fact that, even at the peak of the crisis, the Bank of England were pretty reticent to be delivering rate hikes.
We're early in the earnings season, but so far so good. Are European earnings good enough, expected to be good enough to offset higher oil prices?
I mean, that definitely appears to be the case for now. Every time I walk in the office, I see energy prices higher. We've seen continued attacks overnight between US, Iran, and Euro Stoxx, 50 future is just resilient. So, it's a case of earnings are strong enough. They're expected to remain strong enough. In terms of the key sectors, it looks like energy, financials, and to a lesser extent, consumer staples. They're providing an offset. If we see negative tech today, then that's also a positive for the European equity complex.
Adam Linton from Bloomberg Markets Live team. Adam, thank you. You can get up-to-date analysis and insight from Adam and the rest of the team. Just go to MLive Go on your terminal. Let's get your stocks to watch now with Chloe Melly standing by. Chloe.
Good morning, Tom. Tariffs are very much back on the agenda, with Trump saying that generic drug manufacturers need to move production to the U.S. within 2 years, or otherwise they will face a 100% tariff starting from 2028, which could double to 200% the following year. And so we'll be keeping an eye on all of those names that we've got up here on the board, which are those generics drug manufacturers here in Europe. And for those companies, these potential tariffs would mean a huge increase in costs, and they're already operating on very thin margins, and so for consumers that would mean higher prices and also potential shortages for those very important painkiller medicines and cancer medicines that are offered by those generics drug manufacturers. So we'll be watching out for any impact there on this sector. Moving on to the banking sector, we've got Santander reporting a pretty good earnings this morning, beating estimates and adding millions in customers. The bank has been trying to really expand in the US and in the UK through acquisitions, the acquisition of a TSB and Webster Financial, and this seems to be paying off quite well. It's also benefited from some of those AI productivity gains. We have seen Santander outperform, as we can see here on the graph, the broader banks index, and we could see this continuing today on the back of those strong earnings. And finally, let's move over to Airbus, which last night has unveiled a set of quite ambitious financial targets. It is planning a €5 billion buyback, as well as a doubling of profit over the next 3 years, and this could potentially boost the stock this morning after what has been a pretty weak performance so far this year, as we can see up here. And JP Morgan analysts have said that this is exactly what is needed for the stock to really rally, and so we could be seeing that happening this morning. We'll be keeping an eye on Airbus and this potential boost to the shares.
Chloe, thank you. Chloe Melly with a rundown of some of the stocks in focus. Let's add to that list. We've been talking about generic drugs this morning, so we'll keep an eye on the likes of Sandoz, see if there's any downside there. Also, JD Wetherspoons, the chairman there, Tim Martin, who's always got a lot to say on the earnings day, says full-year profits are likely to fall below market expectations. He's talking about marginally lower than anticipated final quarter sales. I don't know if he was expecting better of the England football team, but I thought that had boosted takings in all kinds of pubs.
You'd have thought that had done quite well. I mean, third place. You'd have thought
quite late.
Pubs were packed to capacity.
They were.
Yes.
But quite late in the evening.
Yes, the 8 o'clock kickoffs would have been better, wouldn't they,
yes,
than the sort of 10 o'clock ones, or, well, better than the 2 in the morning ones, which were terrible.
Yes, precisely. Though some stayed open for those.
Also dangerous. So we're watching those stocks. Yep. The broader picture, then, is this sort of deterioration in Nasdaq futures, isn't it? US futures, as we've headed closer to the European trading day.
When we came in bright and early, the Asian session was looking a lot brighter. The Kospi is up 5 to 6%. That really turned down. So with gains of just 0.7%. So Nasdaq futures now pointing lower by almost 1% after a 2% gain yesterday. Across the futures picture in Europe, interestingly, the FTSE 100 is still pointing higher by about 0.2%. So we'll see if that holds. Oil, no doubt, would be playing its part for the FTSE 100.
Yeah, just listening to the AkzoNobel CEO talking about the impact that energy costs are going to have, is it going to be
long term?
What impact is this going to have on European profitability going forward? Anyway, we are 5 minutes away from the opening trade this Wednesday morning. Futures are mixed. US futures are negative. We'll show you some numbers in a minute. This is Bloomberg. Couple of minutes to go until we start trading here in Europe. I'm not, to be honest, sure that this chart gives us very much in terms of a sense of direction. This is where Europe closed out on the S&P session yesterday. There wasn't much action in the back half of that session. However, since then, if you were to extend that chart, you'd see US futures rolling over quite sharply, particularly Nasdaq futures. I wonder whether, Tom, that is a better lead.
Well, talking of rolling over, we started the show by talking about the relative resilience of the European equity story after the gains of yesterday and futures pointing higher. That has turned around. Futures now for Europe pointing lower by 0.2%. You're still looking at gains for the FTSE 100 pointing to upside of 25 points. Oil will play a role there with prices up 2%, closing in on $93 a barrel, about $93 a barrel right now on Brent. Interestingly, gold and silver still higher as well. So basic resources and the miners could get a lift. DAX futures, though, pointing low by 30 points, pointing low by about 0.1%. The stocks to watch, Anna.
Yeah, let's have a look at some of these stocks to watch. We'll keep an eye on the pharmaceutical sector, the generic drug space in particular. A lot of this, President Trump now talking about a 100% tariff on some generic drugs into the United States in a couple of years. A lot of that will come from India, of course, but there are some European players in this space, so we'll keep an eye on that sector. Santander, very much in focus. We had the CFO on the programme earlier on, and he said that the company is on track to meet or even do better in some of the key performance indicators that they set out for this year, and so we'll keep an eye on the performance of that particular business as a result. And we've added JD Wetherspoons as well, because Tim Martin has said that the full-year profit is going to be below expectations, only marginally, but we would expect to see that one a little weaker at the open then, Guy.
Absolutely. Labour market costs certainly a significant factor for the pub business at the moment. OK, here we go. Let's show you some numbers, give you an idea of what is going on. We've softened up certainly significantly this morning in our expectations for the equity session. The FTSE 100 may get a boost from some of the oil market factors coming into play with the majors, BP, Shell, etc. So we'll watch out for that. There's a number of single stocks you want to keep an eye on. The Santander is definitely one of them. AkzoNobel is definitely one of them. The Airbus numbers last night, the outlook that they gave, they came out of Farnborough into London last night to update investors, and it was a really positive picture, I have to say, having read through some of the details that came through from that. So we'll watch Airbus. FTSE is absolutely flat. Stoxx 600, I've got nothing really to tell you. CAC's down by 0.1%. The IBEX significantly. So it's going to be interesting to see what the market is saying about Santander this morning. He's a little off this morning, down by 0.5%. Certainly looks like a bit of an outlier. So is that a Santander story? We'll come back to that in just a moment. DAX and the SMI are not open. Tom, what have you got on sectors?
Top of the list is energy, not unexpected, of course, up 0.4%. That is the biggest gainer across your sectors right now. Industrial, so some of the defence names modestly higher. That sector is up just 0.1%. Just 4 sectors so far in positive territory. The rest seeing some downside pressure. The biggest loss is actually coming through for tech. That sector is currently down 1.4%. So tech, the biggest loser. Consumer products as well. So luxury within that space currently as a sector, that's down 0.7%. Biggest losses for tech, biggest gains for energy right now, Anna.
Yeah, yesterday tech was the best performing sector in Europe, wasn't it? So that's a bit of a turnaround for that sector. And picking up on that global narrative then, only 4 sectors in positive territory, as you point out then, Tom. We've just got the opening price for some of those generic drugs makers, and it is a day where we're seeing markets down by 0.3%, and we see some underperformance then from Sandoz, which is down by 1.7%. So we were wondering how much of this threat from President Trump to put 100% tariffs on generic drugs, how much of that was going to be priced, and it seems as if maybe there's a bit of movement on that. So we've got that one a little bit weaker. I see Hikma in London is down by 0.8% as well. And Santander, to answer your question, Guy, down by 1.2%, despite the fact that he sounded quite buoyant on the outlook, it seemed.
Airbus is up a lot. So Airbus is the biggest points gainer this morning in terms of what we're seeing on the FTSE 100. I spoke to Guillaume Faury, CEO, a couple of days back. He was painting quite a positive picture, but last night they came into London. They had a big investor update. They talked about the fact they're going to put the engine issue that has really been a big factor for this company behind it, probably by 28. They painted some really positive pictures in terms of what they're seeing in terms of the outlook for demand. The market's really responding and re-rating that stock this morning. We're up by nearly 5% already on Airbus, biggest points gainer by some significant margin.
OK, let's widen the lens, talk to Will Hobbs, Chief Investment Officer over at Brooks Macdonald, get his view of the world this morning. Good morning to you.
Morning, Anna.
Thanks
morning,
very
guys.
much for coming in. Well, we're standing on the precipice of another earnings season from big tech over in the US, and this feels important given the volatility that we inherit daily, it seems, from Asia and the technology session there, and to some degree, volatility in the US tech space as well. What are you looking ahead for? What looks like good performance to you? What are the right messages for big tech to be giving?
Yeah, it's really, Anna, it's a fascinating juncture, isn't it? Because we've had this kind of hokey-cokey between those, in market terms, between those who are the recipients of this giant capex splurge and those who are splurging it. And markets have been trying to allocate how large is the pie that you will eventually win from all of this kind of thing. And so we've seen this incredibly, violent markets underneath more serene index levels. We're obviously, like everyone else, watching what happens with capex guidance. I think more broadly, though, the first thing to point out is that just looking at the banks, the major banks that reported, earlier in the season, the read on the macroeconomy in the US is pretty constructive, I would say. You saw an amazing quarter for corporate loan growth. You're seeing consumer delinquency levels quite moderate. You're seeing all that side of things. So I think looking forward, just getting back to your original question, really the biggest question now are kind of use cases, and this will dominate the rest of the year, I suspect. I saw you interviewing earlier, Santander, and asking, how are you going to monetize this? What are the returns? That's going to be the question I'm afraid you guys are going to be asking.
I know, and to Guy's question, if the costs and the benefits are very distributed across the P&L, it's very difficult to pin down what the return on investment is from this new technology. But you don't think we're in a bubble, and that ties into that thought. You don't think we're in a bubble in this sort of technology?
Not yet. I think, in a way, the sort of big things, I think generally we like to, overemphasize the regularity of bubbles. Bubbles are much rarer than commonly believed, I tend to think. That doesn't mean there's not areas of froth, but we saw that with the kind of leverage play on memory stocks, that there was an extreme moment, but that seems to have deflated a little bit. And actually, if you look at the Mag 7, they've been underperforming a little bit for most of the year. So I don't think there's anything that I would worry about too much. And the reality is that you're still, that's not to say that we haven't had a very intense kind of bull run this last 3 years, but you're still in the midst of this industrial revolution, in amongst an information revolution. And it's very hard to work out up or down in this period. But back to your question, the Santander question, and all of the other questions you're going to be asking corporates investing in AI, the key moment will be process change. As in prior industrial revolutions, it's not when you just buy and adopt and see some sort of changes in use case and various other bits and bobs and some efficiency gains. It's when, as in electrification, your factory managers change the processes of a factory around this new, more powerful general purpose technology that really matters. We're still undecided in terms of generative AI, the burlier brother of machine learning. But I think quite a lot of what we're seeing in productivity gains in the economy at the moment is more about machine learning. It sort of forebears a sense. So, yes.
You mentioned the hyperscalers. Does the sell-off that we've seen, the recent sell-off of hyperscalers, is that an opening? Is that an attractive opening for you?
So I think it's not. I mean, at the moment, we're still focused very much on trying to look to the next stage of the kind of industrial revolution as such. So focusing on the adopters, and that's really knowledge sector players in a sense. So you're looking a lot at, in the UK, banks, legal services, and all those places where you are potentially enterprise data heavy but revenue poor. If this technology reaches its potential, then really a lot of the rewards to the stock pickers are going to be in the areas where you can get a little ahead of the game. And at the moment, we're still, in market terms, most of the excitement and the sex and violence in market terms is in the picks and shovels plays. This trade-off between hyperscalers and memory stocks and where are the supply shortages, and that's where the scarcity is. But as we move down the sort of next stage of this industrial revolution, technology revolution, really that's where a lot of the interest is for us and the valuation appeal in trying to get ahead of the game a little bit.
How are you looking at European stocks through the lens of energy? At what level, Brent, are you modelling $100, 120? That's when it becomes a problem. How are you thinking about the European stock story in that context?
Yeah, so, I think what you are seeing in Europe, and again, this is something you pointed out earlier in the show, was that, parts of Europe are actually picking up a little bit, and current activity indicators are looking a bit more attractive in Europe in particular. Not so much the UK at the moment, which seems to be bumbling along. Yeah, the oil price story, I don't know whether I would go for scenario analysis or just insurance in a sense. At the moment, we still feel that Europe looks to, worthy of some part in portfolios, but not a dominant part. Our overweight is actually in UK equities at the moment still. That's been the case for a little bit.
Versus the US?
Versus the US. So we narrowed that 2 years ago. We had put on the overweight 2 years ago. We narrowed it 3 months ago. We're keeping with it at the moment because there's that valuation appeal. And also, I think, the thing that's underestimated still about the UK economy and parts of the UK capital markets complex is that the UK is a knowledge sector superpower. This is one of the areas where the UK really has incredible comparative advantage across an array of knowledge sectors. As I say, if this technology reaches its potential...
You paint the picture of the UK as this kind of Silicon Valley. It's not. The valuations in this country are rubbish. We need to get them higher. They don't trade on the same multiples as they do in the United States. When you talk about narrowing it, what do you mean?
Narrowing it, we moved 3%.
Right, OK.
So it was a very heavy overweight, which paid off, actually. But I can't take any credit for it because that was my colleagues before I arrived.
Right.
Although, obviously, that's what we like to do, take credit unearned. But if you look at the valuations, I think it does mean... And again, valuations is a much longer-term indicator, as we know. It's not a tactical signal where you can turn around. However, on a 5-year view, if you're looking at where you want to deploy your stock-picking, fund-picking potential... I would say the UK is a very happy zone to start looking around more actively.
If you talk to fund managers about the UK, though, they're really frustrated because there's a load of takeouts at the moment, and you see that happening on an almost daily basis. The companies get taken out. So what you've got to do is you've got to hold, and wait for that moment when the company gets taken out. Like, is that the strategy here in the UK?
Well, you hope that actually, as you know, markets, and you guys know this better than anyone else, markets can move in long-term kind of fads. And the UK has been out of favour for some time.
Yep.
Part of that is the sector makeup. Part of it is that the UK was just whacked to the floor by the great financial crisis in particular and has never really got off the canvas until maybe COVID. And so just investors have been under-allocated to this zone. Now, it might take something a bit more shocking in terms of earnings growth, improving return on equity, all the rest of the things to actually start getting people allocating more persistently to the region, because the US has been the story and now it's Asia which is taking over a little bit. But I would say that that's, in a way, part of our job as investors is trying to look through the fads and try and allocate ahead of where the next fad might move. And my suspicion is that UK is underappreciated from that perspective. I get the frustration. That has been the story. But remember that, in a way, if you're looking at translating sort of, what you're seeing in the universities in particular in this country, and this is underappreciated, is you are moving from, knowledge to seed capital, and it's starting to move a bit faster in the various regions.
Yeah, we do seem to see more news flow in that. Of that nature. But it's interesting to me, Will, that you look at a knowledge economy and you say that's set to gain from AI. Others look at a knowledge economy and say that looks vulnerable to AI. So what's sort of the key to your view?
Yeah, I mean, I think you can look, for instance, in the part of the industry that we operate in Brooks. You know, you can think about advisors, for instance, and how they advise clients on financial situations, tax planning, all those kind of things. One argument would just say, well, you know, tech can disintermediate those people. I would disagree with that very strongly. And again, if you look at past instances of technological change, it's more likely you get superpowers reducing your marginal cost to supply your service so you can supply more people with it. So we're seeing that already from our advisors, that a lot of the admin associated with serving an individual customer was forcing them up the scale in terms of wealth. As AI or machine learning does more of that admin cost for you, your ability to provide those services, legal services, all the rest of it is greater and wider. And that goes at the same time as the country and the wider world gets wealthier.
Nice to see you. Thanks for stopping by to see us. Always appreciate it. Will Hobbs, Brooks Macdonald, CIO. Call 6 looks like this morning. Let's give you an idea of what we are watching here in Europe. Generally a fairly negative picture, particularly around the tech space. Certainly seen Nasdaq futures rolling over. ASML is a victim of that, down by 2.21. Schneider, to a certain extent, is off as well. But it's not limited to tech. You've got Novo off this morning. LVMH is off this morning. Rheinmetall is off this morning. Seeking some safety in Nestle and Verve this morning. OK, what else are we watching? Back to the Airbus story. I have to say, the update last night really has electrified, I think, investors around this space. The stock is up big this morning. Chloe Melly has more.
Yes, absolutely. Good morning, Guy. We are seeing Airbus firmly in the green this morning, up almost 6% after unveiling those ambitious targets last night, saying that it will have a 5 billion euro buyback, that it will double its profits, and also that the engine issues that had really been plaguing operations will soon start to fade. And so we are seeing that really drive the stock this morning, and we are, about almost 6% for Airbus this morning. On the other hand, we've got Wetherspoons, which is firmly in the red. We're down almost 10% after the pub operator issued its fourth profit warning this year. It's been dealing with those much higher costs. That is because of high labor costs, those high taxes, and also just cost inflation, energy prices really weighing on performance. And at the same time, it seems that there's been perhaps lower demand than expected. Maybe the World Cup boost was not as big of a boost as Spoons had hoped. And so we are seeing the shares down very strongly this morning. Moving on to the recruitment story, and we've got Randstad up more than 7% after some positive earnings in B estimates. This follows on from other recruiters posting quite positive results. We had Page Group and Hayes in the UK, and then Manpower in the US, also indicating that maybe this industry that had been in trouble for quite a while over the last few years is starting to see some of those green shoots. And so we're up about 7% this morning. Moving on to consumer goods, we have got Danone being double downgraded to a sell rating by Jefferies analysts, with those analysts saying that there's going to be a lot of competition in the US market and the Chinese market, both markets being, of course, very important for that company. And so we're seeing that weighing on the stock this morning, down more than 2%. And finally, AkzoNobel, the paint maker, is up. It's in the green, about 2%, after posting some resilient earnings. And in particular, it has some very resilient pricing, which helps it absorb cost inflation, and also volumes getting a bit better in the coatings division. So we have positive earnings story there from AkzoNobel.
Chloe Mellet, thank you very much indeed, with some of the stocks on the move this Wednesday. Coming up, President Trump targets generic drug manufacturers, threatening tariffs of up to 200%. We look at the potential implications next. This is Bloomberg.
The 2026 is the first year of this 3-year plan, and clearly we are on track, or even on track to meet or even do better in some of the KPIs we gave for the first year of this 3-year plan. So we are starting on very, very strong footing, and we are very confident that we can deliver on the numbers we gave for the next 3 years.
Santander's CFO sounding quite positive. The numbers sounded quite positive. Anna Bosin sounded quite positive. The stock is down by 0.5%. I have to say, though, it's up quite a lot this year, which may account for the fact that it's down a little bit this morning. Tom Metcalfe joins us, leading our banks team, to talk about this. It looks, these numbers look okay.
Yeah, I think context is all, as you say, the shares are up pretty strongly over the past year. So I think it's, slight dip in the shares, but probably just because they're kind of meeting those pretty elevated expectations. But as you look across the board, it's pretty strong, perhaps a bit light on the trading side, but NII was up. And perhaps that TSB restructuring charge was just a reminder, the bank has got a lot of execution to get through. And so with that, Webster, perhaps it's just a reminder, until that's all kind of cleared through, it's not necessarily going to be easy sailing.
So TSB and Webster, idiosyncratic, of course, to Santander. But is there a read across from other parts of the earnings story from Santander that we can take as we look ahead to other European bank earnings?
Yeah, I think in the core business, it looks pretty good for other Spanish banks. If that NII is up, you'd think that's just going to read across to the BBVAs of the world. And again, the other thing I always look out for is those provisions, those sort of nasty surprises or the signs of distress. Not really seeing that again. So it does seem like it's all kind of going to probably be a business as usual type quarter with a few idiosyncratic things for each bank.
And sticking with the finance beat then, Tom, since we have you here, we of course have a new Chancellor in the UK, and some of what he might or might not do with the UK economy and the banking sector might be of interest. I wonder how the finance industry has been responding to his appointment so far.
Yeah, I think broadly speaking, he's seen a sort of reliable, safe pair of hands, a common sense choice. So definitely a sort of sigh of relief in the city. But it's one of those things where literally his first day was yesterday, basically. And so there's just going to be a lot of speculation about what exactly, they ultimately come to do when, there's a lot of difficulties here with spending.
And you were asking about tax, weren't you, to the Santander CFO? That must be one of the areas. And Jamie Dimon's actually spoken about that and sort of push back in case there's an inclination to increase tax on the bank.
Yeah, it was a very well-timed release podcast he had where he was, saying similar things he said is like, look, we think the banks are overtaxed. We think it's unfair that a US bank like JP Morgan has had this sort of, kind of surcharge on us ever since the global financial crisis, which at least in their view, nothing to do with Jamie Dimon or JP Morgan. But no, quite carefully worded as well, not sort of saying, hey, I will do ABC if say, this taxes come in. But again, just a sign that there is no easy choices here. There's no sort of pot of money that, the Starmers of the world were not seeing.
We're looking for the broadest shoulders,
Yeah, exactly.
It's just not Ed Miliband. I think, honestly, you talk about the first say, all of those things don't sound like positives to me. They just sound like not Ed Miliband.
That's probably fair, I think, and that's kind of the thing is probably the biggest takeaway is, clearly Burnham is aware of the need to kind of reassure the bond markets, reassure the city, at least on that kind of critical point.
Tom? Thank you very much. Thanks for joining us. Bloomberg's Tom Metcalfe with a look at the financial services sector, including earnings from Santander this morning. In other corporate news, President Trump says that generic drug makers have 2 years to move production to the United States or face a 100% tariff from August 2028. That levy could then double a year later to 200% in August 2029. This is, of course, if these generic drug companies don't move production to the US. Let's bring in Deirdre Hipwell, who's Bloomberg's healthcare and consumer team leader for EMEA and joins us on set now. Deirdre, we can dissect this from a whole number of different angles, but thanks for joining us. So what kind of impact could this have on US consumers, US prices? We were talking earlier on in the programme about whether this just looks as if it pushes up prices, whether you make them abroad or in the United States?
Absolutely. It could have a huge impact because about 90% of drug prescriptions in America are generic drugs. And that's everything from antibiotics, painkillers, cholesterol drugs, cancer drugs even. So potentially the effect is huge. But as ever with Trump, he makes these big announcements, but then the devil will be in the detail. So I think what we could see is what happened with the branded drug manufacturers is we might see some carve-out or deals where generic companies try to come to agreements on pricing. So I think, we'd have to be on the lookout for that. But part of me does think he's just trying to get deals here because giving them 2 years, I mean, if you want to get a manufacturing plant up and running, it's going to take at least 3 years. So it's not giving them much time. So they're going to have to hustle if they think that this is really going to come into effect.
Deirdre, has he had some success in arm twisting the pharma industry to build capacity, additional capacity in the US? Can you point to a win there?
Well, he's definitely arm twisting, that's for sure. Whether or not he's actually lowering prices for Americans, I think, is a question that will take some time to answer. I mean, we saw Pfizer, Astra, GSK, all the big drug companies all did deals with him, and a lot of them secured grace periods from tariffs for that time. But there is still a question whether or not this is actually lowering prices for Americans, because the drug supply chain has been built up over many years and it's a very complicated supply chain. So I think it's not clear yet that prices are actually lower for Americans.
Who would lose out here? India looks like an obvious case, but kind of just give us a sense of who the target is, basically.
India would be probably the biggest loser. I mean, about 40% of their exports are pharmaceuticals, one of the top three. And I think it would be very, very difficult for them because they're already facing levies on steel, aluminium, autos, so they would potentially be a big loser. But also companies in Europe, like Sandoz, is a huge generics manufacturer, and they have very little facilities in the US. So their CEO already warned last year that if Trump moved on generic drug manufacturers, it would lower choice for Americans, because some might just choose to withdraw from that market and focus on more lucrative markets.
And you say, though, obviously this is away from the generic drug side, but the wider trade, tariffs, drug story, a lot of the big names have done deals. And has that meant that we have a bit of certainty, Deirdre, as to what kind of tariffs they will face into the United States?
Yeah, well, as I said, quite a few of them have secured deals. They've got grace periods. Obviously, Trump RX was the direct-to-consumer platform that was launched, which discounted prices. So certainly, I mean, Trump will have some things that he can point to as wins against the pharma sector, ahead of the midterm elections later this year, because this has been a big push that he's made. He's often been very upset about the fact that he thinks people like Europeans and in other countries, that patients there are getting much lower pricing than Americans. So he has a lot to point to. But, as I said, I think the wider question will be how long-term this effect will be, and is it really day-to-day lowering prices for Americans?
Okay, Deirdre, thank you very much indeed. Deirdre Hitwell, Bloomberg's healthcare and consumer team leader for EMEA. Coming up, talking of the cost of drugs and what it does to inflation. Inflation here in the UK falling. We're going to dig into the latest data with Rufaro Kiseri of RBC Wealth Management. That is coming up. This is Bloomberg. This is the opening trade. We are 30 minutes into the Wednesday session. Here's the picture across the benchmark then. Essentially flat. You are seeing gains here in the UK, up 0.1% on the FTSE 100. Energy and the energy sector is playing its role there. Bit of caution, though, more broadly in the markets because of Brent at $93 a barrel, because of the geopolitics, and maybe waiting on the sidelines to some extent ahead of the earnings out of the US later, with Alphabet in focus. DAX pointing currently up 40 points. You're seeing relatively decent gains over in France. The CAC current up 0.3%, adding 24, almost 25 points so far. Guy, you're looking at the detail.
OK, let's get into the detail. I'm not sure the detail gives us very much, if I'm being honest, this morning. 258 up, 321 down, volumes a bit meh. Let's kind of park all that. Let's go on to some interesting stock stories, where I think the action is this morning. Airbus out with a big investor update last night. They did it in London following the Farnborough Air Show, and the market is loving it. Basically, they're pushing beyond some of the kind of supply chain issues that they've been facing over at Airbus and painting a really positive picture going forward. The stock is up by 6.25%. We kind of had hints of this at Farnborough, but some numbers put on it last night by the team at Airbus, and a really positive response. Rand stands out with some really solid numbers as well this morning. It's up over 6%, and Equinor in the energy space also gaining. Numbers look good. The kind of the volatility in the earnings space also looks good for it. It is up by nearly 2% too. Laggards, JD Wetherspoons is certainly not having a particularly positive morning this morning, looking a little flat, down by 9%, 8.5%, 9%. The World Cup maybe wasn't quite such a big a factor, but the big cost problem for most big pub chains, certainly in the UK at the moment, is what is happening with taxation, with labour costs, with all of the kind of the taxation that goes around owning and running a pub. It is becoming more and more onerous, and you can see it really reflected in some of the numbers. ASML is down ahead of the big tech earnings we're going to be seeing later on. Santander is down 0.7%. The numbers actually, to most people's read this morning, look fairly good, but this is a stock that's done very well this year. Maybe just a little bit of caution, big price back in. Better to travel than arrive, to use the old cliche. That certainly seems to be the story when it comes to that stock this morning, Anna.
So those are the individual stock movers. Guy, let's get an update on some other news flow this morning. President Donald Trump is downplaying the prospect of immediate talks with Iran as the two sides continue to exchange strikes and Houthi militants in Yemen threaten shipping in the Red Sea. Trump vowed on Tuesday to respond if the Iran-backed group disrupted that waterway, but didn't specify how. Mediators are continuing efforts to restart negotiations, but Tehran has rejected US claims it's seeking more talks. Earnings season heats up this week with Alphabet kicking off the mega cap results later today. Investors will be watching closely for evidence that the company's massive investments in artificial intelligence are paying off. Tesla is also out with results after the bell, with investors eyeing the EV maker's spending and progress on emerging product lines, including its autonomy and robotics efforts. And here in the UK, inflation fell to its lowest level in over a year on cheaper motor fuel and food. The respite for consumers may be brief, though, with higher energy bills set to complicate the short-term outlook. Tom.
OK, well, talking of inflation, that is certainly a factor for the BOJ. A redhead crossing the terminal right now. The BOJ, the Bank of Japan, of course, said to be open to raising rates faster than every 6 months. Faster than every 6 months. The yen getting a pop, currently at 162, so crossing through that 163 level, up just a little over 0.1%. You had seen a pop of about 0.2%. And the BOJ officials see recent yen weakness at levels we haven't seen since 1986 as an upside inflation risk. We heard Japanese officials from the finance minister this morning talking about bold action, but increasingly investors and traders have been looking through the jawboning, and the expectation had been that if the yen was to really have a floor under it, it would be the BOJ. And so we're getting this redhead right now, which is interesting in the context that we've been hearing from the finance minister earlier.
I mean, the chart, it looks dramatic. It's not a big move, but it is quite a big story, isn't it?
Yeah.
You know, a lot of people had said the government, the Ministry of Finance can intervene lots and lots, and we've seen them do that a couple of times this year, haven't we? But it's not until the BOJ steps in. A lot of our guests have told us it's not until the BOJ increases the rapidity, the pace of hikes, that we get some substantial backstop behind the yen.
How far will they go? How far do they need to go in order to stabilise this, get the yen back to levels that they feel, the government feels, are kind of appropriate? The implication of this is it's not kind of, we're not one or two more done. The implication of this is there could be many more rate hikes still to come from the BOJ.
Yeah, something we'll keep on our radar and look ahead to later on in the programme. Let's get back to the UK data out this morning. Joining us, Bloomberg Markets Today editor Sam Unstead with a look at, we started thinking about the inflation story out the UK, didn't we? So let's do that. The inflation picture then, Sam, talk us through the data. What have we learned today?
So I think you actually kind of mentioned this earlier, but the data today kind of has been a little bit overtaken by events that have happened since. So almost all of the slowdown in inflation was down to petrol prices. We started the month with oil prices hovering around $71. When I got up from my desk, they were heading towards 94. So that relief may well be very temporary. And then in addition to that, the change to the energy price cap comes in next month. So the headline data, the headline rate coming a little bit slower is good and relatively benign, you know, as far as it goes for the Bank of England. But the temporary relief is likely to be the case.
So the bank is going to look through the temporary relief and look further ahead. Is that the message you're giving me?
Well, you're now at the point where there's a lot of stuff they're going to need to look through. There's a lot of different inputs. And it probably does provide the Bank of England with a bit more time to keep watching, you know, because, the core inflation and services inflation didn't come down as much as economists expected, but services still coming down. So all of these factors give them a little bit of time, a little bit of space to keep watching as you see whether you get more effects from the initial energy spike coming through in fertilizers in various parts of the supply chain, where the costs start to go from that. And now, you know, we'll have to see what happens because, as I say, oil prices continuing to go up and hovering back above $90 a barrel again. And so that becomes another consideration beyond this initial one. So you've got kind of one spike, a bit of a cooling, and then another spike.
We've broken through 93 in this show. We've now just broken through 94 on Brent, so up 3.4% in today's session, to your point, Sam. Bloomberg's Sam Munstead. Sam, thank you. Let's get another take, a market take on what is happening in terms of inflation and central bank reaction, what it means for fixed income as well, and bring in Rufaro Caricieri, who is RBC Wealth Management Head of Fixed Income Europe. Rufaro, let's start on the UK. The markets are still traders still pricing at about 40 basis points of hikes from the BOE. In the context of the inflation story we've seen today, in the context of what we're seeing with wages, in the context of what we're seeing from this new government, does that seem appropriate to you?
Our view is that we expect that the BOE would be on a prolonged hold for this year, and that's really predicated on what's happening in the labour market more strongly. Of course, the inflation data that's come through, and as Sam's pointed out, it is sort of showing some signs of positivity, but we actually expect inflation to track a bit higher in peak in Q4. So we're not expecting that the BOE would necessarily be reacting too much to the data that they've received today. But on the labour market front, we look at the lagged data. It's starting to show that there is weakness in employment. We are seeing that wage data is tracking lower. And then when we look at the forward-looking data, it's the surveys, the sort of decision-maker panel survey data, as well as the agent survey data. It's pointing to the fact that there is going to be lower employment and also wage inflation to stay around that 3.5% level. So labour markets are not as strong as they were back in 2022, and we think that's going to be the factor that keeps the BOE on hold. But of course, this oil story continues to be a risk to that view, and that could be the potential for maybe a hike to come through. But we think 40s may be overdone.
Okay, 40 may be overdone. It's really all about the labour market. Your expectation, are yields relatively capped from here? Is the political premium priced in? John Healey in the Treasury as Chancellor. Where are we in terms of how you factor in and your views on gilt yields?
We think where gilts are at the moment, so we've crossed over 5% on the 10-year. We think we could certainly reach those peak levels that we reached earlier on in the year. But part of that is really going to be coming from that oil story. If we keep getting sort of escalation in what's happening in the Middle East, that's going to feed in negatively into gilts. We think the political premium is already baked in there, but we think there is still some room for gilt yields to track a bit higher from here. And, you know, as we look at sort of the political risks surrounding what's happening at the moment, the bond market will really be looking for what is going to be the sort of the fiscal message. Is it the adherence to the rules? And we know that that sort of flexibility introduction of language was reacted, bond market didn't like that, and so it's really going to be the case of what's going to be the policy announcements from here up until autumn, and then ultimately how does that look like for the fiscal headroom as well.
Yeah, Rufaro, just sticking with the UK for a moment. I mean, what is the premium for UK debt over Europe? What is it all about? Is it reflecting underlying fears around inflation? You've mentioned the political risk. Sure, that's in there. But what could this new government, new leadership of this government do to try to bring down that spread over European debt?
I think when we look at sort of the UK fiscal picture, it certainly doesn't even have sort of the highest level of debt in sort of comparing to other G7 nations, but the cost of servicing that debt is at a much higher level in comparison to other countries. And so I think some of the aspects for the UK is that our inflation does come down a little bit slower than other countries because of these energy caps that we have. There is also that sort of lingering effect of what happened back in 2022 and that political risk premium also feeding into gilts as well. And so what the bond market would really want to see is really that fiscal prudence. It's sticking to the rules, and it's also setting out plans that are funded and, of course, having fiscal consolidation that seems realistic as well.
Yes, and actually getting some of that done, is that going to be a focus? Because we saw for the last 2 years there were attempts at fiscal consolidation, but then they were U-turned on. Is that's going to be a laser focus, is it, for debt markets?
We think ultimately, I think debt markets can accept that consolidation can happen over a longer period of time. But I think when you have a lot of announcements on reversals and also when you have instances where the fiscal headroom is diminishing quite considerably, then the bond market starts to get a little bit worried. But I think when we look at the prospect of any fiscal measures, what does that actually mean for DMO issuance? And I know we've looked at the public finances more recently where borrowing has been a little bit higher, but actually the cash requirement wasn't as excessive, so that's less of an implication on gilts. But ultimately, it's the cost of servicing that debt that continues to eat into that headroom.
How do you feel about France at the moment?
Well,
paying attention? Starting to pay attention? I just wonder at what point you think the bond market starts paying attention to next year.
I think ultimately we have seen spreads in France continue to track higher, and we have seen that, of course, as we're approaching sort of the elections for next year, the bond market is somewhat pricing that in already. But I think it will start to become more of a volatile period as we get closer and closer, and we start to hear what does some of that policy look like. But we have been underweight France for some time just because of that political uncertainty. We think there are other pockets within Europe that still are pretty interesting, where you have less of a fiscal sort of risk. So we think areas such as Spain, that's particularly interesting. Areas such as Portugal, that's interesting. Italy, less so. And even with bunds, when we look at where bunds are trading at the moment, we think they can track a little bit higher. So we're comfortable being somewhat cautious of adding to bunds at the moment.
I was going to move from bunds to credit, if we can do that. How cautious should we be on credit, given the kind of record issuance we're starting to see?
I think from a valuation perspective, credit spreads are pretty tight, so credit looks pretty expensive. But when we look at it on a credit break-evens basis, credit does look pretty attractive. And I think that's been the allure for a lot of investors to go into credit. We have seen a lot of record issuance in the first half of the year. That's been taken up, and the demand has been pretty robust. We're not expecting the same pace of issuance in the second half of the year, especially coming out of the US.
Why is that?
I think because a lot of the financing has been done in that first half of the year. But of course, there could be some upside surprises. We could see some new deals coming back onto the table. But I think ultimately what we have seen is also the effect of the US tech issuance in other markets outside of the US. So we take Europe, for example, where the tech issuance is 4 times higher than the level it's been in the past sort of 4 years, especially in that sector. So we are seeing that the issuance out of the US is not just affecting the US market, but it's also filtering to other markets.
And I wonder how much, Rafaro, how much you think about the changing nature of the companies who are involved in issuing. So as you mentioned a couple of times, there's a lot of tech issuance. Mm-hmm. And that's been a real break with what we've seen in the past, where these were not businesses that maybe issued a lot of debt. And now they are doing. Mm-hmm. And they have quite good balance sheets, don't they? Still, they're not stretched. So how much does that change the metrics that we need to look at?
I think when we now look at the quality of the index, because some of these issuers are higher rated issuers, so it's actually improving the quality of the
sort
index.
Of flattering the index in a way.
In a way, but then what we're also seeing is that, say, if we look in the tech sector, the tech sector curve is actually steepened because of the issuance being skewed to some longer dated debt as well. So that is changing the makeup of the shape of the curve. But then ultimately, we think on balance, it's not every issuer is made the same. It's important to still look through at the fundamentals. As you rightly said, there's a lot of cash on their balance sheet. So when we look at their net debt levels, they're pretty good levels. But of course, as that cash flow starts to get diminished, as these investments go through, then that's going to be an area that we continue to watch out for. But we think it's an area to be selective in credit. Mm-hmm. But we still think there's some pockets of opportunity, even in tech.
Can I just take you back to the govy space? BOJ raising rates at a faster rate. Rates go higher in Japan. Does that pull money out of Europe? Do you think there's a negative effect that comes through off that?
I think when we're sort of looking at sort of the attractiveness of other markets, and so if Japanese yields are much higher, that's more attractive for domestic investors to sort of go in. And we also know with some of the policy effects to sort of make it more attractive as well.
They want the pension funds to bring money back as well.
And it starts to look a little bit more attractive for capital to flow to Japan. So we think certainly that could change the makeup of where investors are thinking about where to invest. It's certainly a yield hunting environment. We've got a lot of issuance coming into a market. So we certainly think that will make a change to investors' demand.
Rafaro, nice to see you. Thank you very much indeed for coming to see us. We really appreciate it. Rafaro Chiraseri, RBC Wealth Management, Head of Fixed Income Europe. Coming up, Alphabet kicks off the start of the reporting season for big tech a little later on today. We'll discuss what investors should be looking for in all of this. We'll do that next. This is Bloomberg.
Welcome back to the opening trade. 49 minutes into Wednesday's session, and the overall market actually dipping by 0.1%, but not perhaps in the major markets where we see a little bit of resilience. The FTSE 100 being maybe flattered by energy, but even that not doing too much to flatter it. We're pretty flat actually across these markets, Tom. Oil prices are not flat, they're up by 3.9% this morning.
Yes. Tech earnings, of course, in focus. Alphabet prominently, of course. Big tech names reporting this week, starting with Alphabet, kicking off the first set of mega cap results later today. Investors will be looking for clues on how AI spending is reshaping tech. Of course, as chips, well, there was a strong rally at the start of the session in Asia. That faded. Let's get more with Bloomberg Intelligence analyst Matt Bloxham. Matt, what parts of the earnings story for Alphabet are going to be drawing your scrutiny today?
Yeah, quite a few of them, to be honest, because it's such a broad range of businesses. I mean, first and foremost is their ads business, which is still by far and away the biggest part of their cash flow, holding up in the kind of growing surge of AI. I think, so far they've kind of confounded their critics that actually search engine advertising is remaining very resilient, and they've done a good job of blending Gemini into that. Obviously, there's going to be a lot of focus on CapEx again. They already upgraded the guidance for this year and said that next year will be even higher again. I think maybe not so much the CapEx number itself, well, that is important, but how they're generating returns against that. So a lot of scrutiny about all these big investments starting to pay off, both in terms of their own ad revenues, Gemini subscriptions, and also their ability to penetrate the enterprise market with Gemini. So a lot going on there, and there's more beyond that, but it's going to be the big focus for sure, I think.
Matt, let's get your take on a story that I think caught all our attention this morning, and that is this OpenAI story. A couple of OpenAI models meant to be in a sandbox, i.e. cut off from the internet. The AI models figure out a way to get out of the sandbox, i.e. get access to the internet, and then they go to try and answer the question that they've been posed, and they do that by basically going and hacking Hugging Face, which is another company's site. This is alarming, isn't it?
It is alarming, and it just shows you how powerful these models are. I guess in some ways, this isn't anything that new in the realm of cybersecurity. Technology advances, maybe the kind of bad actors get access to it first, and the good actors have to kind of catch up and then maybe preempt what's happening. And we saw this here. So, for example, in this case, an agentic system, as you say, with the guardrails lowered because they wanted to test its capabilities, was incredibly successful and hacked Hugging Face, and actually Hugging Face used its own agentic AI systems to counter the threat.
But it got out of the sandbox. It wasn't meant to have access to the internet.
Yeah, it's intelligent. That's the label on it, and that's what happened with Mythos earlier this year too. They set it a particular task, it did that task, and then it just continued. And so it does provide a very clear warning that this technology potentially does have a life of its own, and there does need to be kind of quite close and careful scrutiny of how this stuff is released into the wild, if you like. That's where, we've already seen some kind of US politicians come out and say, add more pressure to the need to kind of regulate and govern these things. I think it's going to be hard to kind of have effective regulation around this, but it's good to see that, I think to some degree these companies are acting responsibly. They're being open and transparent about what's happened, why it happened, how it happened, and you're sharing information with companies so that they can kind of be more prepared for this going forward.
Okay, yes, and as we saw with Mythos, maybe it acts as an inadvertent sales pitch when you sort of alarm a lot of people about what your models can do. So we're looking at CapEx, we're looking at the regulatory impulse maybe around the big tech space. We're also maybe looking at the crowding out that AI is doing in other areas of tech, and this was a big theme in the IBM early release, and of course we get full numbers from them. But are you thinking about that crowding out? We're talking about AI so much. Boards are thinking about investing in AI so much. What are they not spending money on in the tech universe?
To some degree, and this may well be an incremental theme that comes up now. What other areas have we kind of missed, if you like, in terms of where spending's shifting away from? And to some degree, we've seen this already in, say, some of the big IT services companies, like, for example, Accenture had kind of fairly soft numbers. Publicis that reported also has a big IT service business. They're seeing weakness still in that IT services. So it's not just a diversion of hardware budgets to specific areas. I think it's a divergence of software budgets into AI. Everything is AI. And if you're not AI related, then you're going to get deprioritized. And I think we're seeing this across every sector of the industry.
Okay. Matt, thank you very much. Matt Bloxham, Bloomberg Intelligence Senior Analyst. And everything is AI, Guy, which is part of the reason why we find it so difficult to pinpoint the return on investments in some of these P&Ls and balance sheets.
Yes. It's going to pose some challenges for the AI to figure out that return, I think probably somewhere down the road. That'll be a useful use case, maybe. Just want to quickly recap what we're seeing in terms of one of the big stories we've been developing throughout the morning, and that is this move here. We are seeing a positive picture emerging for the Japanese yen today. The reason for that, indications coming out of the Bank of Japan, the BOJ, that it is prepared to maybe up the cadence of rate hikes. We've seen a lot of jawboning, a lot of intervention. It hasn't worked from the Japanese authorities. The market's been waiting effectively for the BOJ to deliver more. Now we get hints that that is about to happen. Warner Cunningham, editor at Markets Today, the newsletter, joining us now around the table. That's basically it, isn't it? We've waited for the Japanese. They've tried everything else, and now they've got to do this. Raise rates more aggressively.
Yeah, and they've said that they will do so. They're prepared to do so, and that is by more than economists have been forecasting. So we have seen market reaction there. We've seen the yen recover after it's obviously been down at a 40-year low overnight. I think the question will be how long that lasts. It's one thing to talk about raising rates, and also just as the authorities have indicated that they would be prepared to step in to support the currency. But we actually need to see that happen, I think, for that trade to continue. Because
so the market to be convinced you actually have to get the rate rises?
I think you do, because at the moment, the other factors are still at play. I mean, oil prices are rising as we speak. There doesn't seem to be any letup in the escalation in the Middle East. And that's really what's driving those inflationary concerns in Japan because of the strengthening dollar, and we're seeing continuation of that trend this morning.
Yes, and oil prices are stronger, up by 3.6% now, Morwenna. Just briefly, this is continuing to raise questions about inflation, push yields higher.
Yes, exactly. And that's something which we're seeing around the world as well, but particularly I think in Japan because of that sensitivity. The dollar has been benefiting from this increased conflict, and that doesn't seem to be showing any signs of abating at the moment.
Yeah, OK. Morwenna, thank you very much. Bloomberg's Morwenna Cunningham. On the subject of those oil prices, Iran saying that an exchange of messages is possible with the US, but currently no negotiations with the US. Those comments not moving the oil price all that much. It is still substantially higher.
It is. It's a lot higher this morning as well. Don't miss the conversation that we've got. Charlie Sharp's going to be on our air a little bit later on. He is the Wells Fargo CEO. Looking forward to that conversation, 2 p.m. London time. Thanks for watching. This is Bloomberg.